huge tailwind for gold, considering gold gained $700 an ounce, 40%, during what was arguably the harshest rate hiking cycle in Fed history. Gold set a new all-time price record, and it did that because people were talking about 5 or 6 rate cuts. That narrative totally evaporated, as I just said. And if gold had been pricing that in, we would have seen a priced-in premium evaporate as that narrative evaporated. And instead, we gained $300 an ounce. So I don't think it's been priced in.
Special coverage of the Deutsche Goldmesse is brought to you by Victoria Gold Corp.
Hello and welcome back to Soar Financially, here from the floor of the Deutsche Goldmesse in Frankfurt, Germany. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. And I'm really looking forward to welcoming Brien Lundin here on the back on the channel, and welcome to Frankfurt.
Wonderful to be here. Great event you put on here. Thank you so much for inviting me. It's been just incredible. Lots of really smart investors, great companies. Very enjoyable and enlightening experience so far.
Well, I've been stealing some ideas from your event, so
yeah, I've noticed.
Stealing from the best.
I've noticed the bills in the mail.
Oh, fantastic! Good concepts. Like we try to merge what we liked.
Yeah,
we took from various conferences, and yours was truly an inspiration. I do have to admit that, and I'm super thankful for that. You made the trip from New Orleans across the pond. It's not easy.
It isn't easy. I may fall asleep in this interview, in fact, but yeah, it's well worth it. It's well worth it. A wonderful event again.
Oh, phenomenal, Brien. Let's dive right in. You presented yesterday. You were the closing keynote. Fantastic topic as well. But let's sum up maybe what were some of the highlights that you wanted the investor to take away and walk out of the room with.
Yeah, I guess the thrust of my presentation, and it was actually had 2 titles. I had the title I gave you a few weeks beforehand, and the title I settled on a few days beforehand. And a few weeks ago, it is what in the world is happening with gold, because we still really didn't have a feeling of what was driving this move. And my title that I came up with a few days before was "Who Needs a Pivot?" And to summarize that, we were expecting a Fed pivot to be the big driver for gold this year. We were expecting that to send gold up a couple of $100 through the course of the year. And that narrative and that expectation kind of faded away in the first couple of months of the year when it just didn't happen. And then the narrative switched to perhaps only three rate hikes this year. And now it's evolved to perhaps no rate hikes this year. And if we didn't know anything else, we would look at that and say, wow, what a lousy story for gold. I bet it lost a couple $100. And instead, we gained a few $100 just through that whole period. And so that left people literally scratching their heads. Why? What's going on? And we had no idea during the first couple of weeks of that move. And I think we've kind of figured a lot of it out. The easy explanation was central bank buying, which was strong in 2022, strong in 2023, seems to be keeping pace. A lot of buying from China, both the People's Bank of China official demand, but also really strong domestic demand, which is unusual to see Chinese investors buying as the price is rising. They usually buy when price declines. So what else is going on? There's been a lot of speculation on the COMEX. We've seen Western investors almost exclusively be focused on that, not the gold ETFs. And we've seen some over-the-counter trading and other exchange trading in China globally. I get the feeling there's still something else. There's still mystery in this market. We haven't really pinned down where that's coming from. But I have a feeling the why relates to the fact that gold's rising while yields are rising, while the dollar is rising, safe haven demand, in other words. And I think that it's a growing unease over the global macroeconomic situation, and there's strong money moving into the sector in that regard. So my message to investors, distilling all of that down, is we were waiting for a pivot. We haven't gotten that. It's still ahead. That's still a huge catalyst. The Fed leading other central banks toward the down cycle, the rate cutting side of the cycle. That's going to be a huge a huge tailwind for gold, considering gold gained $700 an ounce, 40%, during what was arguably the harshest rate hiking cycle in Fed history. So it should do much better when that comes about. And the other important point is that mining stocks, although the majors have leveraged that move in gold, they really have not leveraged it as much as we thought, and it hasn't trickled down to the junior mining stocks, which still, in relation to gold, the mining industry, mining equities in general, remain at multi-decadal low levels. So the opportunity is really generational right now. We have factors and arguments and drivers for gold that we would dream of having, and yet there's still bargains galore in this sector.
I 100% agree, and we're just at the beginning. What inning would we be in?
As a mining
Second,
conference
third?
promoter, I would hope you would 100% agree. You have to be an optimist.
I forgot my pom-poms, right?
Yeah.
But Brien, you mentioned the Fed pivot might still be a catalyst. I'm going to counter that and ask you, has it been priced in? Because the Fed hasn't changed rates since July. Powell was extremely dovish in December, hinting at 3 rate cuts. Hasn't happened yet, but he keeps saying fairly dovish. Although it seems like he's doing a bit of a 180 without doing a 180 by, inflation's still not under control. So I'm curious, is it priced in?
That's a great question, and one that I've been asked at this conference a number of times by very smart people. It's a smart question. Let's look at the history of it. The gold market started to price in that dream scenario of 5 or 6 rate cuts. It started to price it in December. Over the holidays, when nobody was paying attention, gold set a new all-time price record. And it did that because people were talking about 5 or 6 rate cuts. That narrative totally evaporated, as I just said. And if gold had been pricing that in, we would have seen a priced-in premium evaporate as that narrative evaporated. And instead, we gained $300 an ounce. So I don't think it's been priced in. I think there has been some speculation, some hot money speculation, but that's been backstopped by money that's come in even when yields are rising, even when the dollar's been strong. It seems to me that buying, that deep well of buying, is coming in for other reasons that are related to why yields are rising and why the dollar is strengthening. And I think that's basically running for safe haven.
Okay, no, thanks for answering that question. I was curious because we haven't seen anything out of the Fed since July.
Right.
So there's a lot of talk, but no walk in either direction.
Right, exactly.
No.
Exactly.
Let's pivot a little bit. Stay on the Fed, but I want to ask you now, if you were Jerome Powell, what would you do?
I'd run.
Where to?
I would walk, I would close my briefcase, I would walk past my secretary, I'd find a cabin in the woods, I'd buy canned goods, gold, silver, and ammunition, and drop out, because he is in a no-win situation. He really is. There is no way out. There is a trap that the Fed is in. They will have to lower interest rates. They are very likely to start lowering interest rates without having killed off inflation. That is the perfect scenario, another one of those dream scenarios for gold. That tells the market that the central bank, what we know is that the debt loads today are incompatible with interest rates where they are. That's a stark reality, it's simple math. The Fed recognizing that, however, is another step. The Fed has to cut rates before it's killed off inflation. It is throwing its hands up and telling the market, telling the world that the situation is untenable and they're no longer in control. That would be the dream scenario for gold. Interestingly, it seems to be shaping up that way because the debt service costs are soaring. Even if they started cutting today in a fairly drastic manner, those debt service costs would still rise. The average rate paid on Treasury paper right now is 3.28%. And across the Treasury curve, we see that where they're floating paper, it's around 5%. that gap, even if they started cutting rates tomorrow, they're not going to narrow that gap, and therefore paper will reset at significantly higher rates. Our debt service costs will go up because of higher interest costs, but also because the debt is soaring. If we're running $1.5 trillion deficit this year in the U.S., well, we have to add another trillion on just debt service costs to that. So, of course, where are they going to get the money? Well, they just borrow more, and that's a debt spiral.
I missed it, but apparently April 29th, the refunding announcement came out for this quarter.
Yeah.
So I'm curious if you've seen it.
It was pretty much in line. There was some speculation that it might come up with some shocking numbers, but
We would have heard about that, I think.
yeah, we would have heard about that. As I saw, I forget the actual numbers, but I saw the commentary that it kind of came out in line with expectations. Now, some of that would be managing expectations, but it wasn't any kind of a shock to the market.
Well, let's talk about inflation real quick. It's an interesting one because it's been going up 4 months in a row now,
Yeah.
and it is not it's sticky, it's actually increasing.
Yeah.
So, how do you handle that? And you mentioned, rising rates might
Yeah.
be one way, but it doesn't look that way because Powell tries to avoid talking about a rate hike as much as possible.
Yeah.
All right. So, what are some of the other scenarios?
He's been surprisingly dovish or sanguine in the face of this. Doesn't think that there are any Fed rate hikes, that's, in his words, unlikely. I think he's recognizing that they can only keep rates this high without significant impact on the economy. The other side of that sticky inflation is that we've seen GDP growth slowing. So that's when everybody now is talking about stagflation. Even the mainstream talking heads on the primary financial media channels are talking about stagflation now, and Powell said he doesn't see the stag or the flation. I really do like Powell. I think he's the best of an unwholesome lot, I think they're in a trick bag right now. I think that inflation will remain stickier and harder to kill off. Getting to 2% is a hell of a goal, and I think it's going to settle into the 3 to 4%. And of course, we've seen in the history of these kinds of situations, like the 70s, it looks like you killed it off, and then you have another spike, and then it looks like you killed it off, and you have another spike. And the only way to kill it off is to essentially kill off the economy, and I don't think the Fed's going to do that.
Not in an election year.
No,
So not until November at least.
Yeah, and I don't think they can in any respect. When Volcker did it, it took superhuman effort and commitment to do it in the 1970s, but at that point, the debt was about 35% of GDP. Now it's about 125% of GDP. So they don't have the same toolbox. Powell and his cohorts don't have the same tools that Volcker did. And so they couldn't do it. They can't do it.
One last thing about the Fed and the Fed announcement this week was they said we're reducing QT from 60 billion to 25 billion. What is the impact of that? What does that mean?
That's QE light, essentially. Of course, he tempered that by saying it doesn't mean that we're not going to get to the same place. We're just going to get to it more slowly. That's what you would expect him to say. But it is a loosening of financial conditions when they are putatively still trying to kill off inflation and have an ultra-tight monetary policy. So that really heartened the markets. We saw a very positive reaction in risk assets because of that, and gold as well. And I think the market took it as what it is.
Well, S&P was up, gold was up.
Yeah.
I think I didn't look at the dollar, I have to admit. I can't remember if it was up or down, but
I think it was fairly
flat. Yeah, I think we're still at 106 roughly on the Dixie.
Yeah.
So right around that level. Let's talk about how that is impacting the miner. Let's make the segue to the mining industry here. We talked about it, $2,400 gold. What does that mean? What's the impact?
Well, we're not quite at 24. We're back at 23, which is, and a little bit below actually right now. We're kind of oscillating around that. The miners haven't really moved because I think the rally in gold was stunning and shocking, and everybody expected a pullback. We're kind of in that pullback now. But the other factor that I think has hindered investment in the mining sector, really prevented that FOMO from having an impact, is the fact that people really don't understand the reason why for this rally, and there's still some mystery involved in it. And I don't think that the understanding that there has been some speculative buying on COMEX over-the-counter market and in Shanghai Futures Exchange, that isn't very comforting, because that's more speculative. That's not necessarily the kind of buying you'd like to see. I think there's stronger hand buying that's playing a factor in that. But if we understood what was driving it, if there was a recession in the U.S., some kind of a financial event, something where we could look ahead and say, okay, now we're going to have a couple of years at least of loosening economic policy, looser money, Fed cutting rates, then people would be placing big bets on the miners right now, because they could see ahead and see that this is a trend that has some legs to it. Right now, we can't look ahead and really understand what this trend is, or at least most investors can't. For us and the smart people at this event, we can look ahead and say, hey, we've still got a pivot coming up, and there's the macroeconomic argument for gold is very strong and secular in nature.
Well, so we're just at the beginning.
Yeah.
We're just at the beginning.
We're in the early innings, yeah.
It is just starting to trickle down.
Yeah.
And I think maybe Q2 numbers might be more important than the Q1 numbers. Maybe that's when investors start to believe.
Yeah, the market can only ignore free cash flow for so long. And although there were a lot of arguments of what the true ASICs were for big gold producers a couple of months ago, whatever those ASICs were, whatever their costs of production were a couple of months ago, they're $300 an ounce higher today. So those kinds of numbers coming in, I think, are going to convince generalists to invest more. We've already seen some moves into the bellwether Newmont, which is the only one on the S&P 500, and therefore would naturally attract the initial funds into the sector. So I think it's going to improve, and we're going to see that reflected across the sector in the months just ahead.
Phenomenal. Brien, I really, really appreciate you coming out to Frankfurt. It means a lot. Thank you so much for your support. Where can we find more of your work?
Goldnewsletter.com and NewOrleansConference.com. And you can find me on Twitter/X at Brien_Lundin.
Phenomenal. Brien, thank you so much. Enjoy the rest of your time in Frankfurt. Really appreciate if you made the trip. Thank you so much.
Thank you so much for the invitation.
Anytime. Everybody else, thank you so much for tuning in here to Soar Financially from the Deutsche Goldmesse, from the floor of the Westin Grand Hotel in Frankfurt. If you have any questions, any thoughts, any commentary, positive, negative feedback, put that down below. We do want to hear from you. It means a lot to us. And if you haven't done so, hit that subscribe button. Thank you so much. And we'll be back with lots more from Frankfurt. Thank you.